The investment strategies of the world's wealthiest individuals are often mythologized as sophisticated secrets accessible only to a financial elite, yet upon closer examination, their methods reveal a consistent philosophy. A long-term mindset, asymmetric risk-taking, disciplined diversification, strategic patience, and a deep understanding of both human behavior and market cycles. The richest individuals do not simply buy assets. They design ecosystems around their wealth, treating investment as a multi-dimensional craft that blends psychology, timing, ownership, leverage, and influence. Their portfolios are not collections of random bets, but reflections of worldview, how they interpret risk, opportunity, and the future. To study how the ultra-wealthy invest is to study how they think about the world and their place within it. Their strategies differ not only from average investors, but from traditional institutional logic, because extreme wealth enables a unique form of freedom, the ability to withstand volatility, pursue unorthodox opportunities, and commit capital for decades rather than quarters. Understanding these strategies reveals not only how fortunes are built, but how they endure through generations. The first defining principle among the wealthiest individuals is an obsession with ownership over speculation. They understand that true wealth is built not through trading, but through owning productive assets, businesses, real estate, intellectual property, infrastructure, and technology platforms. Warren Buffett's empire is rooted in this philosophy. Buy wonderful companies at fair prices, hold them indefinitely, and allow compounding to work its quiet magic. Jeff Bezos similarly built Amazon not by maximizing short-term profits, but by reinvesting aggressively across decades, turning temporary losses into future dominance. Elon Musk invests in companies he controls, where capital becomes a lever for shaping the future rather than merely capturing return. This ownership mindset contrasts sharply with the behavior of ordinary investors, who often chase market movements, seeking quick wins instead of durable advantage. The wealthy understand that ownership multiplies wealth because it multiplies influence. Owners shape strategy, culture, and innovation in ways no trader can. Another core principle is concentration with conviction. While traditional advice emphasizes diversification, the wealthiest individuals often concentrate their wealth in a small number of high-belief investments. This is not reckless gambling, but strategic focus. They invest where they possess unique insights, unfair advantages, or deep expertise. Mark Zuckerberg's wealth is overwhelmingly tied to Meta, Bernard Arnault's to LVMH, Bill Gates' early fortune to Microsoft. These individuals understand that outsized returns come from asymmetric opportunities, situations where potential upside dramatically exceeds downside and where their involvement amplifies that upside. Yet, paradoxically, they also diversify across asset classes. Once foundational wealth is secured, they combine concentrated wealth creation with diversified wealth preservation, shifting strategy as scale increases. A third cornerstone of their strategy is the mastery of long-term time horizons. The world's wealthiest individuals treat time not as a constraint, but as an asset. They resist the impatience that dominates modern markets. Where average investors panic during downturns, the wealthy accumulate. Where others see crisis, they see discounted entry points. Long-term thinking transforms volatility into opportunity. This is why Buffett eagerly buys during recessions, why Ray Dalio studies centuries of economic cycles, why sovereign wealth builders like the Rothschilds maintained fortunes over generations by anticipating political shifts rather than reacting emotionally to market noise. The wealthy understand that wealth compounds not only through returns but through patience. Patience to wait, patience to endure, and patience to allow the invisible mathematics of exponential growth to work. The ultra-wealthy also deploy leverage strategically, not recklessly. Debt becomes a tool for amplification, not a trap. Real estate tycoons like Sam Zell, industrialists like Rockefeller, and modern billionaires in private equity all use leverage to acquire assets that generate cash flow greater than the cost of borrowing. This leverage accelerates compounding while allowing them to preserve liquidity for new opportunities. But unlike average borrowers, they use leverage with strict discipline. ensuring that even severe downturns cannot force liquidation. They view leverage as a privilege reserved for those who can manage risk, not as a shortcut to wealth. Another hallmark is investment in private markets, venture capital, private equity, early-stage companies, and alternative assets. The public markets offer limited access to exponential growth because by the time a company goes public, much of the earliest value creation has already occurred. The wealthiest individuals seek the opposite, early access to innovation before it becomes obvious. They fund founders, buy distressed assets, acquire controlling stakes, or build companies outright. This strategy allows participation in value creation rather than mere value transfer. Wealthy families historically invested in shipping routes, railroads, oil fields, and industrial empires long before they were mainstream. Today's billionaires invest in AI, biotech, space exploration, clean energy, genomics, and robotics with the same pioneering vision. In addition to private equity, the ultra-wealthy embrace alternative assets that diversify against inflation, currency risk, and geopolitical instability. These include fine art, gold, collectible assets, rare wine, luxury real estate, farmland, and infrastructure. Such assets maintain value independent of market volatility and often appreciate when traditional markets fall. Wealthy families like the Medici, Rothschilds, and modern sovereign funds have long preserved capital this way, demonstrating that wealth is not only built but shielded against uncertainty. One of the most misunderstood aspects of ultra-wealthy strategy is their reliance on information asymmetry. They invest based on insights unavailable to the general public industry networks, geopolitical intelligence, technological trends, or early operational data. This does not imply unethical behavior. Rather, their networks organically produce superior context. A billionaire in technology hears emerging trends years before markets catch on. A billionaire in retail sees shifts in consumer psychology long before analysts do. This informational advantage shapes timing, conviction, and strategic focus. Another defining habit is the use of systems instead of decisions. The wealthy do not rely on spontaneous judgment or emotional reactions. They construct systems investment frameworks, advisory networks, risk models, governance structures that guide decisions consistently. Systems reduce noise, prevent impulsive behavior, and ensure that decisions align with long-term objectives. Ray Dalio's principles, Buffett's value framework, and the Rothschilds' multi-generational structures all exemplify this systems-based approach. Yet no strategy operates in isolation from psychology. The wealthiest individuals master the emotional game of investing. They remain calm during chaos, disciplined during euphoria, skeptical during hype, and focused during distraction. They avoid the psychological traps, fear of missing out, loss aversion, herd mentality that undermine typical investors. They see markets not as battlegrounds, but as ecosystems shaped by collective emotion and opportunity. Ultimately, the investment strategies of the world's wealthiest individuals reflect a coherent worldview. Wealth is built through ownership, amplified through leverage, preserved through diversification, compounded through time, expanded through private markets, and protected through disciplined psychology. Their success is not the result of secret tricks, but of principles executed with extraordinary consistency. They understand that investing is not a game of predicting the future, but of positioning oneself to benefit from it, anticipating how innovation, technology, demographics, and global dynamics shift the landscape, and aligning capital where those forces create asymmetric advantage. The deeper truth is this: the wealthiest individuals do not invest to get rich. They invest to stay influential, relevant, and strategically positioned in a world of constant change. Their portfolios are not static, but living expressions of vision, curiosity, resilience, and the belief that wealth is both a responsibility and a tool for shaping the world around them, expressing not only financial ambition, but philosophical intent as their capital becomes an extension of their worldview, shaping industries, communities, and even cultural norms. In the second phase of this exploration, the narrative shifts from the structural principles of how the wealthy invest to the deeper psychological, strategic, and generational dynamics that transform wealth from a mere accumulation of assets into a long-lasting engine of influence, resilience, and purposeful design. If Part 1 reveals what the ultra-wealthy invest in, Part 2 reveals why they do it, how they adapt over time, and what distinguishes fortunes that endure from fortunes that disappear within a single generation. A defining characteristic of enduring wealth is the transition from personal investment strategy to institutional wealth architecture. The richest individuals do not manage their wealth as individuals, they manage it as institutions. Family offices, trusts, holding companies, and multi-layered governance structures replace ad hoc decision-making. This institutionalization is not merely administrative, it is strategic. It ensures continuity across generations, protects assets from political and economic shocks, and preserves the family's ability to deploy capital flexibly. The Rothschilds perfected this model centuries ago, creating a decentralized network of family-controlled banks that allowed them to weather wars, revolutions, and economic crises. Modern billionaires follow a similar path. They build systems that allow wealth to operate independently of the founder's lifespan, temperament, or circumstances. Their investment philosophy becomes encoded into organizational DNA. Another advanced dimension is generational diversification of skills and vision. While the first generation often builds wealth through entrepreneurship or visionary risk-taking, future generations shift towards stewardship, philanthropy, and strategic influence. Contrary to stereotypes about wasteful heirs, many wealthy families intentionally prepare their successors through financial education, exposure to global issues, and participation in managed investment committees. The ultra-wealthy understand that wealth without capability creates fragility. Thus, they view education not merely as academic attainment, but as strategic preparation for multi-generational decision-making. A fortune built through risk is preserved through discipline. A fortune preserved through discipline grows through innovation. Each generation contributes a different strength. Another crucial layer is philanthropic strategy, which, for the wealthy, is rarely separate from investment strategy. Large-scale philanthropy functions as a reputational shield, a tool for influence, and a testing ground for systemic problem-solving. The Gates Foundation's work in global health is an example of philanthropy as strategic investment, applied capital deployed with the discipline of a private sector venture fund. Philanthropy also grants the wealthy a seat at policy tables, shaping discussions around climate, education, technology, and social infrastructure. Far from being purely altruistic, philanthropy often complements their investment worldview by stabilizing the very societies in which their wealth circulates. At the tactical level, the world's wealthiest individuals excel in narrative positioning, a subtle but powerful investment skill. They understand that markets are psychological ecosystems driven by confidence, story, and symbolism. When Warren Buffett writes an annual letter, markets listen. When Elon Musk speaks about the future of energy or space, capital flows into those sectors. When Ray Dalio publishes insights about macro cycles, governments take note. Their words become signals, shaping perceptions and attracting resources. This narrative leverage is not manipulation, it is influence derived from credibility. Wealth amplifies voice, but results amplify credibility. Together, they create a feedback loop that strengthens investment positions. The wealthy also master opportunity timing, not by predicting the future perfectly, but by preparing to act decisively when rare windows appear. Crises, economic crashes, technological shifts, geopolitical upheavals become fertile ground for generational wealth building. While average investors retreat in fear, the wealthy deploy capital into distressed assets, undervalued companies, and emerging technologies. They buy when liquidity dries up. They accumulate when fear peaks. They negotiate aggressively when others cannot. This contrarian behavior is not accidental. It stems from liquidity management, emotional discipline, and the belief that opportunity is not evenly distributed, but clustered in moments of chaos. A fascinating evolution occurs when the wealthy shift from investing in assets to investing in systems-level change. Instead of asking, which companies will grow, they ask, which infrastructures must exist for the future to unfold? This is why billionaires invest in renewable energy grids, AI research, genetic mapping, satellite networks, clean water systems, supply chain automation, and cybersecurity. These investments are not merely profit-driven, they shape the architecture of tomorrow. The wealthy understand that whoever builds foundational infrastructure controls not only revenue streams, but the evolution of entire sectors. Another advanced strategy is geographic diversification, which extends beyond buying international stocks. The ultra-wealthy physically redistribute their presence. Multiple passports, residences across continents, diversified jurisdictional exposure, and global citizenship planning. They anticipate political risk the way ordinary people anticipate weather. This geographic strategy allows them to escape instability, capitalize on emerging markets, and operate with agility when regulations shift. Wealth becomes borderless, while opportunity becomes global. Yet the wealthiest individuals must negotiate a paradox. The bigger the fortune, the more fragile it becomes. Excessive concentration creates regulatory risk, social backlash, or political targeting. Excessive diversification creates dilution of purpose and loss of strategy. Thus, enduring wealth requires balancing scale with subtlety, remaining influential without becoming a lightning rod, remaining ambitious without provoking destabilizing scrutiny. The final evolution in ultra-wealthy investment strategy is identity transcendence. Wealth at this level becomes detached from personal consumption and reoriented toward legacy, impact, and meaning. Many of the world's wealthiest individuals reach a point where material accumulation loses its emotional charge. Their investment theses begin reflecting deeper philosophical questions. What world do I want to help create? What problems can I solve that governments cannot? What structures will endure after I am gone? Wealth becomes a medium for existential expression. Investment becomes authorship of the future. Portfolio allocation becomes a form of storytelling, an imprint of values, vision, and belief. In the end, the investment strategies of the world's wealthiest individuals are not merely financial patterns, but psychological architectures shaped by time horizon, worldview, resilience, and intentionality. Their choices reveal a fundamental truth. Wealth is not just a number, it is a form of power, a form of responsibility, and a lens through which individuals attempt to reconcile ambition with legacy. The richest investors do not simply seek return, they seek relevance. They do not merely accumulate capital, they orchestrate influence. They do not just build portfolios, they build futures. And through this interplay of ownership, discipline, vision, and generational design, their fortunes evolve into engines of continuity, shaping industries, guiding innovation, and leaving imprints on the world long after their founders have passed, reminding us that in the realm of extreme wealth, investment is not the end of the story, but the mechanism through which their story continues. Completed.